Hi guys and welcome back to the Mindful Investing channel. Today I want to revisit with you Tencent, Naspers and Prosus. The base of those investments is all Tencent. So either you buy Tencent directly via their ADRs or you buy them indirectly to Naspers or Prosus. So to come up with our expected returns if we were to invest into Tencent, Naspers or Prosus right now, we have to first value Tencent. As always, we'll value Tencent using our simple discounted cash flow model. To be able to value Tencent using this simple DCF, we have to first make a couple of assumptions. First, we have to assume Tencent's free cash flow growth rates for the next 5 years and for the 5 years following those 5 years. Then we have to assume Tencent's price to free cash flow multiple at the end of our holding period, so basically in 10 years, and Tencent's annual buyback yield over our holding period. So let's begin with our assumptions for Tencent's free cash flow growth rates for the next 5 and for the 5 years following those 5 years. Personally, I like to base my free cash flow growth rate assumptions on Tencent's historical free cash flow growth rates. When we calculate Tencent's compound annual growth rate for its free cash flows based on the last 3 years, we come up with an annual growth rate of around 18.5%. Because I want to be conservative and to factor in some of the regulatory issues in China currently, I only assumed a free cash flow growth rate for the next 5 years of 13% and for the 5 years following those 5 years of 9%. Next, we have to assume Tencent's price to free cash flow multiple at the end of our holding period, so basically in 10 years. Because the price to free cash flow multiple, like basically all valuation multiples, is derived from the future expected growth rates of the business, I assumed a price to free cash flow multiple for Tencent at the end of a holding period of 15, because I still expect it to grow at 9%. Next, we have to assume Tencent's annual buyback yield over our holding period. Like with our growth rate assumptions, I personally like to base my buyback yield assumptions on Tencent's historical buyback yield. When we calculate Tencent's annual buyback yield based on the last 5 years, we come up with a buyback yield of positive 0.51%. So basically Tencent diluted its shareholders by 0.51% per year. To be conservative, I assumed a future dilution of 0.6% per year. Always remember that it's better to be surprised to the upside. Because we assumed Tencent's free cash flows to the whole company, which is usually funded by debt and equity, which bear different costs, we have to calculate a weighted average cost of capital to reflect those cost differences. To do so, in a simple DCF, we just enter Tencent's current market cap, its interest-bearing debt, and its interest expenses. So now we can finally calculate our expected annual rate of return, so basically our cost of equity or internal rate of return, by simply adjusting our discount rate until the value in the green box is equal to Tencent's current enterprise value per share. When doing so, we come up with a cost of equity, so basically our expected annual rate of return of 17.7%. So altogether, Tencent seems quite an interesting investment, even based on our quite conservative assumptions. So now let's have a look at the Tencent investment through Prosus, which basically is a Netherlands-based holding company which owns around 28.2% in Tencent. First, we have to calculate Prosus' current market cap, which we do by basically multiplying its shares outstanding by its current share price. Then we can calculate Prosus' discount to net asset value by simply dividing its market cap by its net asset value. Because Prosus doesn't have any meaningful debt or cash, we can just ignore this for now. Now we can factor in the discount we were able to acquire Tencent shares through Prosus into our valuation. When we do so and again adjust our cost of equity, so basically our annual rate of return, until the number in the green box is equal to Tencent's current enterprise value per share, we come up with an expected annual rate of return of around 25.4%. So a Tencent investment through Prosus offers even higher returns than a simple investment directly into Tencent. And remember, we didn't even factor in any of Prosus' other holdings, for example Stack Overflow. So finally, let's have a look at the Tencent investment through Naspers. Naspers is a South African holding company which initially invested into Tencent and recently spun off its Tencent stake into Prosus in an attempt to narrow the discount. Because of the spin-off, there exists quite a complex holding structure. So for example, there is a cross-holding between Naspers and Prosus, which basically means that Naspers owns a stake in Prosus, which again owns a stake in Naspers, and this stake basically also owns a stake in Prosus, and it goes around and around and around. So to come up with the actual stake Naspers owns in Prosus, we could either go around this unlimited circle until we kind of get close to the actual stake, or we could simply look at Naspers' website. On their website, Naspers states an economic interest of 41.7% in Prosus. Now we can again calculate Naspers' discount to net asset value by simply dividing its current market cap by its net asset value. Again, there isn't any debt or meaningful cash, so we can just ignore this for now. When we do so and again adjust our cost of equity, so basically our expected annual rate of return, until the number in the green box is equal to Tencent's current enterprise value per share, we come up with an expected annual rate of return of around 31%. So based on our assumptions, an investment through Naspers would offer the highest annual rate of return. But we have to keep in mind that the discount to net asset value has existed for quite some time. Even after the Prosus spin-off, the discount hasn't really narrowed. So we have to keep this in mind when looking at our expected annual rate of return. So that's it for today's video revisiting Tencent, Prosus and Naspers. Feel free to ask any questions in the comments and leave a like if you enjoyed the video. As always, please do your own research, your own due diligence, and never simply trust a guy on the internet telling you that there might be a potential investment opportunity. See you next time.